Hi everyone, and welcome to the Financial Fox, investing and innovation ideas with a twist. Today is Thursday, so we are talking smart investing with Clem.
Hi everyone, and welcome to the Financial Fox, investing and innovation.
Sorry. That was just a play. So smart investing with Clem Chambers and Zach Meir. So I'm going to wait for Clem and Zach to join. This is going to be pretty interesting because we are going to talk about obviously some macro issues. So we are seeing inflation rising, consumer price, particularly in the UK, is at the highest level since 1997. And there are some kind of funny things happening on the stock market because usually gold prices should go up in this kind of economic situation, in this scenario, basically. And this is not really happening. So you are seeing some big mining company, they are paying crazy dividends and the price is still flat. And it's not going up, and it's very unique. It's very different from what everybody is expecting. So the question for investors is, where should I put my money? How should I hedge the current situation? Is better to buy value stocks? Should I take more risk with small cap? Should I stay away from oil and gas, for instance, or should I invest in gold, for example? And so we are going to discuss all of these, some tips as well, and what I would like also Clem to do it. Hi, Clem.
Hey.
Is really to maybe see how he uses ADVFN to get data that can be valuable for making investment decision. I think that is always something very important, because as an investor, somebody can say, where should I go? How should I start? What should I do? What should I look? It's not everybody is a professional traders. And what we are trying to do is trying to help people to have better skills and, try to save, how can I say, some of the, try to invest better and don't fall in the traps that some investors have already experienced in the past, like as a learning curve, everybody lost money, but, ideally you should try to learn how to not lose them, isn't it, Clem?
Well, I mean, it's a steep and expensive learning curve if you dive head in. And I mean, I think the first thing that people should do is try to be good investors before they try to be good traders, because investing is really not as high risk as it's made out to be, but trading definitely is. If you look at, say, the FTSE 100, it's very easy to invest in the FTSE 100 if you think the long-term future of the FTSE is good. You just buy a tracker, ISF. And that's it. You can watch it every day. You can do all that. You can just sit there knowing that you've got full exposure to the index. It's not costing you anything to buy or sell it. You've got it, and off it goes. It even pays your dividend. I think currently the ISF is paying a 3% dividend or something like that. So actually, if you put £1,000 in, you get £30 a year just sitting there. But as you get a feel for these things, you'll be able to take more risk on. And people say to me, "Oh, well, these high risk investments are worrying." Most investments are not high risk at all. You're guaranteed to lose all your money. There's no risk in there. You are going to lose all your money. So the first thing you have to do is just look at things where it looks like you might lose your shirt, and then just avoid them. So start out with the low risk stuff and then move into the more risky stuff. Now, risky is a badly understood idea, because risk just really means volatility, if you want to look at it like that way. And, risk equals reward doesn't mean the more likely you are to lose your money, the more you're going to get paid. Obviously, that's a contradiction. risk is just a measure of uncertainty, and uncertainty is a measure of volatility. So how much this crazy stuff moves around is really the risk that you're taking on, that you get paid for. But if you go into things where you might lose everything, I mean, it's not really, it's out so far on the edge of what risk is called. You just don't want to go there. So as a starter, you just want to start with the most boring things that you can possibly find in shares and move slowly in and watch and read and play with the tools. Now, we at ADVFN go to 4 different types of investor and trader. That's people that are only interested in price, people that are only interested in the company's numbers, balance sheets, etc. People that are interested in news. I popped up this morning to say, oh, this is happening. And fourth, and what a lot of people really love, is gossip. So we have those 4 sort of quadrants, and most powerful tools are the ones that you actually are good at using, as opposed to ones that might seem as if they're clever. And the most powerful technically tool is level 2, which is actually an order book, which is something quite complicated. But basically, the market has an order book of people that want to buy and sell. And you come in and say, I want to buy, and you grab some shares off that order book. Oh, I want to sell. You drop some shares onto that order book. But to actually see that order book, to see who wants to buy or says they want to buy, and see who says they want to sell, you need level 2 for that. And that's not cheap. That's £30–40 a month. But it's a very powerful tool.
Okay, Clem, that was a great introduction to kickstart the conversation. Just say hello to Zach that joined.
Hello to Zach.
Zach. Maybe he's still trying to tune in. But so let's
landing an aircraft.
Yeah, perhaps. Maybe just trying to get connection. But let's go back to that. So if can you just explain the value of seeing that order book as like a real example? Let's say there is a massive news or there is a
let me give you an example.
Okay, you go.
That I actually personally use it.
Okay, that's
now
cool.
I have a broker who will remain nameless, and you can only put a limit order in. That means you can say, I want to buy at this price. Now, if I wanted to buy, say, £100,000 worth of stock, I could put it on that price and only get partially filled, because the price would have gone up. I would have taken all the available shares that are for sale at that price, and I still want more, and I'm not going to get them. Yeah, so I then actually go on the order book on the other side. I'm a buyer. I'm sitting there waiting for someone to give it to me. Well, if I've got the order book, I can see that happening to me. Now, another way to look at it is I've got another broker who also remains, and it gives me a quote. I go on there and it says, oh, this is the price you can buy this share. Do you want it or not? I can see on the level 2 book whether that's a better price or worse price than I should be getting with the market. And sometimes it isn't. Sometimes I come back and say, oh, no, you can't buy at all. Oh, no, you can't sell at all. I can see the orders on the order book, but they just can't get to them or won't get to them. I don't care. So that gives me a feeling of whether I'm getting treated right or not. Another example was another broker who would also remain nameless in the COVID crash. And they pulled the ability to put normal orders in. And I had to use something called fill or kill to get out of the market on that first day when it started to move down. And I could only do that because I had level 2 and I could see where all the orders were and at what price, and were they moving fast or were they moving slow. Could I actually put my order really low to make sure I got all my stuff sold? Because I didn't really care. I just wanted to get out. And the level 2 gave me that resolution of what was going on, rather than a broker on the other end going, it's 9.5p, do you want it or not? I can actually see all the different markets, the London Stock Exchange version, Actis version, BATS and all those guys, all what's going on tick by tick by tick, trade by trade by trade. And it gives me a very, very close look at what's going on, rather than being out in the wilderness, getting offered a price by a robot that says, no, you can't have more than 2,000. Or no, we haven't filled your order. Do you want to just sit and wait? No. Maybe
an excuse to get them sacked as well.
Well, you know, technically, all the professionals, it's like, I would say, if you're going to trade, it's like, you know, how would you like to play for tennis for money against Federer? And you go, well, I never do that. Oh, why would I do that? I'm going to lose. Well, the professionals who are trading the market, you're probably going to lose against them if you're a beginner. However, even if you're good, if you haven't got the right tennis racket, if you haven't got the best tennis racket out there, you're going to lose even if you're as good as he is. And tools are incredibly important, and we offer the best there is.
Right, that's a very interesting insight on level 2. So I can see the value also. For instance, you can see if there is a seller in a stock. So then, rather than just jump in when you know somebody's just selling in, you might be wait and just try to get in later.
Well, there really is a million and one ways to use these tools, and I'm sure there are great ways to use them. I have no idea how to do it. Have we got Zach now? Zach,
Exactly.
Are you here, Zach?
I'm here, but I've got technical difficulties.
Oh no.
But you can hear me anyway, so no, it should be all right. But I wanted to have you on headphone, but I can't. There's noise around me. But anyway, there we are.
So, Zach, we were talking about level 2 with Clem. Do you use it, and how do you use it?
I think I sort of heard half of what Clem said, which is obviously worth more, double or triple any normal person. But the situation, I think he was sort of almost like paranoid. It sounded like the market is like against you or could be against you and stuff like that. And if you use level 2, then you can see the market as it is. Was that fair summary? Or?
Well, I think there's certainly a lot of traders. If they're trading, they are trading against. That's the whole point, because they're not investing. They're just trying to buy before it goes up and sell once it's gone up and it's about to go down. They've got no view on the next 10 minutes apart from trying to make money out of somebody who's selling or buying. So in as much as the market will always in the short term be against you, there are lots of players in the market who are not your friends. And a lot of the brokers provide very poor service, and it's good to know that you're getting it, because you can change your broker. It's a wherever there are resources, there are predators, and the market has a lot of resources and there's a lot of predators. And if you're going to go into a jungle with predators, you better take a really, really reliable gun, and a powerful one at that, and one that can shoot really quick. And
But isn't it the case that rather than not being your friend, it's just like most operators in the market, they don't care, and they don't care what price you get filled or whether you're making or losing money. Obviously, they prefer it if you're losing money. My experience level 2 is it tends to be too short term, so you just get blinded by the numbers and the market makers going on the offer and the bid, and so it can be a distraction unless you're like trading minute to minute.
Well, a lot of people are, and I don't disagree with you personally. As I said, I've got various brokers that offer limit orders. I wouldn't do a market. And if you looked at a market order on level 2, you'd see why you wouldn't really want to do a market order. And so it depends on your scale as well, and it depends on your time frame. I totally agree. If you're an investor, if you're Warren Buffett, you don't need level 2. Well, you probably do at your size, but it's less interesting or useful if you're long term. If you're buy and hold, I mean, you don't even need a share price. You just buy it and hold, and hope that when you retire, you're not poor. And and that's what indexes are for. I mean, if you bought an ISF, which I can see the level 2 on, etc., maybe I could even trade it. I mean, you just need to see the front page of BFN once a month, don't you? And or even not there, you just put it in like some people put their money into funds. They put them into funds, and they get a letter from their fund manager twice a year saying, "You've done well. You've not done well." So it depends on your focus. But if you are the sort of person watching this broadcast, you are probably highly focused, and you probably do want to learn how to do more than long-term buy and hold invest. And as such, you need to be looking at tools.
What are the upside of investing with a fund or to just buy an ETF, for example, rather than just going out yourself and find opportunities? This is just a question that perhaps many investors, they want to get started, just say, oh, should I buy?
Well, I think Zach should answer that. Otherwise, I'm going to answer it in the next 27 minutes. So, Zach, what's your opinion on that?
Oops.
Oh, you lost your sound. We can't hear you, Zach.
I think it's mute. So yeah.
What happened?
I'm here, right? Okay. So now, what I wanted to say, because I can't hear you very well, but what I was going to say is that I am a fan of level 2. I actually got it in 1988. I had a topic screen in my house. It cost 20 grand a year, and it was difficult to maintain or pay for that 20 grand a year. But I was that keen on all that I learned a lot from that. Obviously, it was a bit expensive, but I'm all for level 2, and in fact, as much visibility and transparency on the market as possible. But I think that unless you know how to use it, it's one of those things that it's like a gun or it's like a car. If you don't know how to use it properly, results can be fatal. So I think that's really what I'm trying to say. And in a way, it's not just having level 2; it's having somebody to educate you on how to use level 2, which is really important. And maybe that's something that ADBFN and others can try and help people with.
Well, we do on occasion. We do have materials, and yes, I mean, I couldn't live without it. I mean, but Stephanie's question about why wouldn't you invest with funds? Why wouldn't you buy trackers? And the answer is most people should, because you've really got to love the market to get involved in it as much as Zach and I do. I mean, obviously it's a profession for me, but I do absolutely love it. Absolutely love the market. But if you just thought, oh, this is dry and boring, then you really want to put your money with a fund, because you don't want to be spending 10 minutes a day, 10 hours a day, whatever, in front of the screen. It's just like the dullest in the world for you, and therefore you should not want to. It's like hating tennis and being made to play it. Buy television and watch it occasionally. It's much probably better for that person that doesn't like to play tennis. Zach and I love it. If you said to us, well, actually, we almost sometimes feel retired because we are doing the thing that we love. And when you do the thing that you love, you can't get enough of it. You want all the tools, you want everything to play with, you can't get enough. But if you really aren't into stocks and shares, you should buy ISF, or you should go to a fund.
Yeah, I think that's a fair comment. Zach, what do you have anything to add to Clément's?
Yes, I do. I think that he's absolutely spot on. I get upset at the weekend because there's no market, so it's a terrible time, Friday, Saturday, and Sunday, and so it's awful.
Crypto is on 24/7. 365.
Exactly.
I know, but then unfortunately, the people that you live with don't take very kindly to that. So it's that's not a big winner either. But proper time during the week.
You're not hardcore enough. People in your life, come on. There's the markets.
Yeah, exactly.
Well, some of them are related. Some of them are related to me, so it's rather difficult to get out of that one. But that was my own fault. But no, I think you do sort of think on a bad day, you sort of think, why didn't I just put money into a fund and just sit on the beach? And that is a conundrum.
The thing is, if you give money to a fund, right, unless the way I feel it, unless really I have not much knowledge and I don't have time to do it, then otherwise it's like, right, I'm going to give to that person because it's actually better than me in trading. You should ask yourself that question: can you be better to that person if you've got all the tools and you can learn? And perhaps, yeah, maybe I'm better than them at trading. But yeah, if you don't have time, then perhaps that it will. The most sensible decision is definitely to give up to a specialist and let them helping you. But
investing is a very valuable skill.
Well.
Investing is a very valuable skill, but there's a huge number of very valuable skills that you could learn and make good money out of. But if you enjoy, people are watching this, most of them will really enjoy it. Yeah. Most of them will really have fun. Because one of the reasons people don't make money in the market is it's so entertaining. And that entertainment has to be paid for. And they pay for it with their profits.
Yeah.
And the market will pay you in whatever coin you require. And if you actually are here for fun and gambling and entertainment, it will take it £7 an hour out of you, like the cinema would. But if you're in it, or that isn't your overwhelming reason for being there, if you're there to make money and you're prepared to do the study, then it's a very lucrative activity. And I think we all can, at the end of this very good bull market, we can all say it's been a very lucrative period.
Okay, let's stop here. We have got some really bad news about consumer prices rising, gold is stagnating. I don't know even how to say. So I think the traders are getting a bit frustrated. I mean, is that, Clem, what you're feeling? What feeling do you have?
Well, I feel I'm an idiot right now. I mean, I don't get it. There's inflation and gold's going down. I've got a ton of gold, and do I just trade what I see and say I got this wrong for some reason, get out and just sit on my cash rather than my gold, and just sit there and go, don't get it, or am I just a bit early? Should I just sit on my gold and let time take its course? I'm there's clearly a big issue going on with the way that QE is going. Clearly, people think that there's going to be, the QE is going to stop, maybe the US stimulus isn't going to happen, and we're going to go into some recessionary, deflationary death spiral. But I can't see that. I really can't see it. I know government's stupid and all that, but I can't think it's so stupid it's going to get itself sacked and destroy its own pensions by letting the economies go into a deflationary death spiral. Inflationary death spiral, yes, that's what they always do at the end of major catastrophes. Inflationary death spirals is the way that they always go, be it the First World War, be it the Second World War, be it all the other problems that countries see. So I don't get it. My thesis is being slapped about by the market, so it's telling me I'm wrong, and I can't see how I can be.
How many times is the fundamental, you have an idea there's inflation coming or there's deflation coming. How many times has that trade or such a trade like that, anticipating a fundamental change, actually worked? Did it work in 2008? Did it work in 87? Has it worked? Did it work with the oil market?
You can read my stuff on Forbes. I've called every crash and I've called every bottom. I mean, that's done me very well. You can read it. So this is the first time I seem to be totally out of sync with the way the market is behaving, and I find that unsettling.
So you took a position short equities, or you got out of equities in 2007 saying, or 2006 saying this is a bubble.
Yeah, no, I said the credit market's frozen. It's the 800-pound gorilla. Equities must follow. There's going to be a crash. You can read it in full. You go to Google now and find it. Yeah, and at the bottom, it's the bottom. Get in. It's going to be great. And
how long do you have to wait for those things normally to happen? Is it 6 months, 3 months, a year? What is the time frame?
Crashes. I get out probably one time in 3, and it doesn't happen. Yeah. So, for example, in 2017, when they were doing quantitative tightening, I got out there because I thought, well, they're going to break this, and it did start to go. But then the Fed went, oh, change your mind, got in, and it all happened all right. I got out a little bit early from the crash. Again, you can read all this because it's all on Forbes and etc. When the crash came in, I got out the day it started. Thanks to Steffi, who rang me up and said, "Oh, mamma mia, my mum again locked up in Italy. Oh, COVID, this terrible thing." And I thought, well, I better get out of 25% of my holdings, and I'll get out another 25% a couple of days later. And if it keeps going, I'll get out. But when I came to get out on that day, all the brokers were swamped and the systems were breaking. And I thought, if you can't trade, you've got to get out of everything. So I got out of everything. And you'll see me writing about getting back in at the bottom of this trade. I got out halfway up it. And then I got back in when the vaccine came out. And I got out of it again about 10 weeks ago. Yeah, and I'm out. But I've got back into the gold and stuff. But generally, I get these things right. And I'm getting this wrong now. And I find this lack of the market agreeing with me disturbing. It's just plain weird. But I think it's because the QE is being slowed down. And there's an element of QT going on because they're basically twisting the yield curve. And it's money flow that's doing this. It's just about money flow. and the money flow is causing all sorts of distortions. Two, a lot of the market is running on autopilot because of COVID. So that means that things have got their own sort of logic and momentum. The algos are doing what they've been trained to do in a different market environment. So the bottom line is, I think that it's all a mess. It's all very chaotic at the moment, and as such, you know, I'm at a loss to know what to do. I'm 60% in, so I'm not completely in. I'm 60%, and I'd like to be 110% or zero in. But so I'm caught between a rock and a hard place. So I'm caught between obvious inflation trade and the fact the market says no inflation, no. I mean, what's the man to do?
So you still sit on 6% gold stock, isn't it?
60% stock, yeah, about 60%.
Okay.
Which is way too much. I actually, yesterday, I sold down a whole load of precious metal leaps. I've had a whole load of options, long options for 2023. And I thought, everything's telling me, you know, this is not good. So get rid of the high risk stuff, which is obviously options, which are crazy things to have anyway. So I cleared out my precious metal options, and that's the first stage. And if I keep getting these crazy precious metals are evil signals, I shall back out of this trade.
Could be that QT is kind of slowing down the kicking off of gold, or is that gold as
well? The money flow. I mean, I can't see. Gold's not that huge an industry. One of the troubles with it is that gold is a long way away from the investor. When you're buying gold, you're not buying gold, and therefore there's a kind of a spongy spring between people, real demand for real gold, and people buying it through mines, through ETFs, through options and futures and all that stuff. Because there's this paper gold world, which is much, much larger than the physical gold world. I know for a fact that the people that mint gold coins can't get enough slugs, because these days mints don't make their own slugs. They don't buy bullion and melt it down into discs and hammer them. They buy the discs ready made. And they can't get enough of them because the physical gold market seems to be dysfunctional. So, you know, how can the people that make gold coins not get enough and the gold price not go up? And that seems to be one of the reasons, I think.
Can we say that gold has lost its
shine?
Yeah, as a hedge, as an asset to hedge, safe haven assets.
Well, I mean, Zach is not a fan of gold, and I've never been a fan of gold, but it seems like a brain dead thing to do right now, and that's been shown to be brain dead. So, Zach, what's your thoughts?
Crypto is gold.
Okay, expand on that rather than Clem doing it. I wanna hear.
You know, crypto is the new gold. It's very, very simple, and it's like buying. You have Ethereum, or you have Cardano, or you have this or that, and that's like buying, emeralds or diamonds or gold, or whatever it is. You've got just a selection of agreed markets, which are they become, well, I suppose they're stores of technology or type of technology, and gold is a store of value. But as I said, I think gold has been ruined, but partly by real estate, and then partly by the need to retain value in fiat currencies. And so gold is kept very low, and gold is as low as the dollar is high in value. The dollar is probably idiotically high over compared to what it is. But they've a ratio between the dollar and gold, so that you don't have a dollar today is worth about probably 2 cents of what it was in 1970 or 80, but it would be worth even less if the ratio between the dollar and gold was not fiddled and fixed. Gold is a totally fixed market. There is no way it should be $2,000. It should be wherever. I mean, it should be 10,000 or something like that, or 20,000. We don't even know. Probably where it could even be where Bitcoin is. That's how. With all the pumping that they've done over the years, especially since 2008, gold should be wildly higher, and it's it's amazing that, people have not sort of called some kind of an inquiry as to how the gold price is only $2,000. It's unbelievable. Unbelievable.
Okay, so you said basically crypto.
Gold, if gold was working properly as a store of value, it would be much higher than it is, but it's a fiddle market, it's a rigged market, and the supply and the physical side underlines that. You can't get the stuff. I mean, I think Clem has said that on previous broadcasts. The link between the gold market price and the supply situation is laughable.
Broken. Okay, so you basically said crypto is the new gold. Now, one aspect of gold is to be to protect against volatility, right? Where crypto is not protecting against volatility because it has got volatility embedded into the assets. Mm-hmm. So, what is the gold alternative?
No, I don't think gold was protecting against geopolitical volatility. It's not something that we were quite happy in 1980 when there was the Iranian crisis or whatever it was, when it went to $1,000. You're quite happy to have gold going to that level from soaring. It's a store of value, and it's a reflection, or was a reflection of geopolitical certainty or uncertainty, and it's not doing any of those jobs at the moment. Didn't even go up when North Korea was going to nuke all its neighbors. It's just not working at all as a proper market. It's just like a dead duck, really. I mean, obviously, it's nice for many gold producers to, they produce it at $800 or $700 and they sell it, $1,800 or whatever it is. But it should be much, much higher. I think it's, it's just literally so obviously at the wrong price.
But it's very interesting that you mentioned the gold mines, because some of them are paying 5%, 6%, 7% dividends. Yeah. So it's like, okay, you can't get arrested for with your cash if you want to get interest. And there's these stocks that make gold, which should be good in inflation, paying you a 6% dividend. Yeah. Why aren't those stocks at a level where they're paying a 3% dividend? Like most people would be happy with. I mean, it's to suggest that gold somehow is going to collapse in value in an inflationary environment. My brain just goes. Now, you should, if you're a big, strong trader type, just go, whoa, I'm right and the world's wrong, and I'm going to load up and I'm just going to sit here and I'm just going to make so much money. But I'm afraid I'm not made of steel. I just go, I can't get it. I've got a lot of it, and I'm just tempted to say I'm going to sit here and get my 5% dividend on my 10% on BHP or 7% on Rio. Yeah. And wait for the world to catch up. But I'm at a loss to know to understand why it already hasn't. The only reason why Rio and BHP and gold mines should be paying these huge dividends is that gold's going to go down and their profits are going to go away. But how can that be? So I'm at a loss. Maybe I'm just early. I hope I'm early.
Well, no, but but the point from that comes, what is it when you're investing or trading or getting involved in the market? Why do you have to, pin a story to a price?
Well, I don't. I just say it's paying a 10% dividend and it's making great profits.
Exactly. So there's no, so there's no, exactly that.
I shouldn't be able to. It shouldn't be there to have it had. And the fact it's there to be had means that maybe something's happened that I don't know about, which means that the comeuppance is already in the price. But I can't see the comeuppance. I can't see them cutting their dividend. I can't see their share price crunching. I can't see that. So why can't other people on the other side see that they should be getting a 10% dividend on a miner that's only going to do better, and be bidding that up until it's a 6% or 4%? I mean, I don't get it.
But it seems to me that you normally you're like a themed investor, so you go by ideas and perceived fundamentals, where the easiest thing would be just say, I want some stocks. Where's the best dividend stock? Where's the cheapest growth stock, et cetera, and not try and.
You also don't know. Actually, I'm a contrarian valueist, so I look for things that don't make any sense in my head, unless the market's just missed them. And but you shouldn't miss a BHP or a Rio because they're so blooming large that there shouldn't be a contrarian play to be had there. So anyway, it's so contrarian and it's such a value investment. I'm starting to, want to change my glasses because I can't believe what I'm seeing, really.
If we go back to crypto, Clem and Zach, I mean, one of the things and the trend that we were saying earlier on this year, it was about, crypto is probably going to have a crypto winter, price is not going to reach 100,000. Clem, have you changed your mind on that? Do you think that we are going to pushing higher, or we are just going to kind of settle around, between 40 and 50 and $1,000?
There's an extremely important thing that's happened. And that could be massively good for gold actually as well, but for crypto, massively important for crypto. And that's the Chinese social clampdown. And they banned crypto. Here is down here. I wonder why they did that when they were making hundreds of billions. They banned. They're now smacking around Macau casinos. Ooh, I wonder why they're doing that. That's a money laundering place. Crypto is about money laundering. So if you're going to clamp down on your society and throw a few billionaires in prison camps, you're going to want to stop people fleeing with their money out of your country, right? So they've clamped down on crypto, they've clamped down on Macau casinos, they're clamping down on Hong Kong, they're clamping down on computer games, they're clamping down on educational things, they're clamping down on Alipay, they're clamping down on all things they don't like that they might undermine their social control.
Yeah, well, but there's a totalitarian state. That's what they do. They clamp down on everything. Clamp down on your foot if you move it too much.
Sure, they haven't been doing that quite so much over the last 20 years. But if that blows up or blows back in their face, then crypto will absolutely go through the roof. And
I think the problem is that we in the West seem to be adopting by stealth, and we have done for the last 30 years since the end of the Cold War, all the greatest hits of the Soviets and the Chinese, and that's the real worry. I think that information, democracy, freedom of speech, and then also, like, even with the trading thing, that if you want to open up a spread bet account or one of these other things, it's like a nanny state nightmare, and the paperwork, and you're not, you're treated like a sort of a dangerous alcoholic when you're gambling on the markets. I think that's the problem, that you're not allowed to, retail investors are not allowed to trade crypto. You've got so many things now that I don't see we're actually just sort of meeting the Soviets and the Chinese halfway, and that's probably another problem with the markets. They're fixed they're fiddled and fixed and rigged markets as well, increasingly. For instance, the Fed is not let the stock market go down. Interest rates and the bond markets are totally they're rigged as well. They're totally fiddled. They're basically whatever the central banks want them to be. It's actually in a way, the reason for the volatility in crypto is because, at least to date, that hasn't been a centrally fiddled market. And that's why it had such a great run. If it was like gold, I mean, if governments had their way, Bitcoin would be pegged at $10,000 or something like that forever, so that you couldn't speculate in it, and you couldn't enjoy the growth in that market. The only things which they want to go up are obviously the real estate, so they which you can tax.
Well, they own it. Basically, they have lots of that themselves.
So that, I think, that's the real thing. But when I hear about China doing this and doing that, I think it's it is actually laughable, because we're doing so many things here in that way, but maybe in a more polite way, or under the guise of climate change or regulation, or it's good for you, or this and that. But the whole thing with COVID and the vaccinations, and if you're not jabbed, you can't do this. That seems to me a real dangerous situation. The only good thing about it is that if you want to have exposure to companies that make money out of regulation and compliance, that's the real winning thing at the moment.
About the Chinese social clampdown is that in the short term that might actually drive a lot of upward pressure on crypto. That's my only point. I don't disagree with your meeting the Soviets and Chinese halfway with an authoritarian bent. I think we've all seen that over the years increasing. But when you have a Cold War, you've got freedom versus autocracy. And then when the autocrats collapse, then the freedom people don't have to be so free anymore. They don't have to give your peasants so much freedom. But outside of the political theory and all that, I think that
that's why a lot of your, but that's just why a lot of your, your fundamentals on the financial markets are skewed by the control, the very strong control that there is, and not allowing an orderly market, which in many instances now we don't have orderly markets. We don't have an orderly bond market. We have a fake stock market rally. We have all these things, which then that's why. I mean, we have gold down because it's fiddled. It's not, gold should be, as it should be $10,000.
You can't hold the market forever. It always wins.
Well, no, but you can't. No, but that's the thing. No. I think that's the point we've seen. They can. They've held gold for 12 years now, 13 years. It should have exploded in 2008. It should have exploded from 2008 with QE. Gold should have exploded, and it hasn't.
It hasn't done badly since 2000. I mean, I can't remember what it was. Wasn't it $250 an ounce?
No, but that was different. Since 2008, I'm going to check the chart. Since 2008, it hasn't actually done very much at all. I'm just looking at the monthly chart now. All right, so it was $800 then. Let's be fair. So it's like sort of halfway house. But it's given how much money has been pumped in by into the system by central banks, gold, and I will say inflation has been fiddled as well. So that's the other thing. So we can't actually tell what inflation is. So that's the other thing. That's the other thing which hurts gold. If there was a 10% inflation rate or 8% or whatever it really is, that the gold would be much higher. But if you look at it and say, well, the inflation's like 2% or 3%, well, obviously that's not good for gold, is it? So everything has been completely distorted and skewed. Inflation figures are phony, bond markets are phony, stock market is phony, etc., etc. So that's why your normal thinking or sane thinking doesn't work, and it's not working at the moment because we really have gone mad.
I think up until this point, it's done just fine. So what you're saying makes me want to buy more gold. So I believe that you can't fix the market forever.
Okay. Clem,
it's the wrong way to think about it. The way to think about it is go where the opportunity that you understand is going your way. Yeah. And I think
I take your point. No, I take your point. I think you're absolutely right. It does actually make me want to buy gold more because when the dam bursts, it's going to go to 10,000 in 3 weeks. That's what's going to happen.
Because it's a dam burst trade, but I've got a feeling that we're not going to get that dam bursting anytime soon, and maybe it'll be a better place to be. But I'm at that. The world's changed. It's a different world post-COVID. And the point is understanding what that is going to be for the next 5 years. And I see it as there's going to be 50 to 100% inflation in the next 5 years as a compounding thing. And not every year, but over that period of time, your pound is going to buy you 66 pence worth of stuff in 5 years' time, maybe 50 pence worth of stuff. So where do you A, protect your capital in that zone, and B, maybe make a profit out of that wave? Or maybe make a really nice profit out of that thing. And I think that is that question. The obvious question is buy gold. Well, clearly gold, somebody hates it. Yeah. Well, crypto, yes, and I'm a big fan of crypto, but it's all over the place. Again, incredibly noisy. You don't want it. Real estate seems problematic. Yeah. And bonds, you're going to get killed. So you're out into the wilds of sketchiness once you get away from those big chunks. Maybe you just buy the FTSE tracker, as we said at the beginning, and just say, forget it. I'm going to go for a long walk, come back in 5 years and see that the FTSE is now 11,000 or 12,000.
I was just thinking, is there an event or anything specifically investors should look at to see perhaps the gold trend to turn around? Like you said, the same with crypto, right? So the China element can actually push gold higher. What about gold? What we should look for?
Well, I mean, the trend was solidly up, and then something whacked it, and it went solidly down. And now it's in a period of chaotic movements, which don't seem to match with the news. So wait for it to establish a new trend. I don't know. I don't know. If I knew, I'd be telling you. I mean, I think Zach's theory of and gold being the anti-dollar is quite interesting.
Yeah.
Because it's like, well, the dollar's strong because they're going to be tapering the tapering. I don't know. Forex is the hardest game of them all. What do you think, Zach?
I think it's that ratio between you know, if you allowed gold to go up, then obviously the value of the dollar is just completely going to, you know, it's going to be down. If gold was where it's supposed to be, the dollar would be worth, you know, 20 cents. Obviously that would be, you know, we'd be in a Weimar Republic's scenario in terms of the US economy and everything else. So I think it's used as some kind of anchor on everything. Gold is really important as an anchor, but it needs to be, there's a sort of a peg with the dollar, but obviously as we're not part of that game, it's very difficult for me to describe what it is, but it just makes sense to me that gold is down and it's been kept down so that the dollar has a relatively strong value against all the money printing that is going on, let's say.
Well, I mean, the thing to watch is the Fed's balance sheet, because it's going up. But in fact, it looks like they might be shifting their angular a little bit. It's been going up in a straight line, 4-week cycle, up a little bit, down, cross, up. But it's 4 weeks. You go see it, and on the Fed very kindly provide you with that chart week delayed. And if that goes up, keeps going up, the market will keep going up. Now, you could say, well, you know, they could get all sorts of tricks to make the market go down while they put money in, or the market go up where they take money out. All sorts of, you know, buying the short end and selling the long end of the bonds, buying the long end, all that twisting and all that. However, if you want to see which way it's going, just look at the S&P. The S&P is just a diagonal line. It's like someone at the Fed went, oh yeah, well, the S&P is going to go like that, to further notice. And it is going like that. There's no volatility in it. It's a straight line. It's like if someone shot an arrow. You know, it's, yeah. And it's like the one thing about, I mean, this is Zach's area. He's the maestro here. But when something is a proper trend, it doesn't mess about. It just goes in a straight line with very little volatility, because volatility is uncertainty. And if there's no uncertainty, because everybody knows who is in the know that the Fed's going to keep doing X, Y, and Z, there won't be any volatility in it. The stock market becomes a bond. It just goes like that, yeah? Until that breaks out of that trend, that's the way it's going. Because it's only going to break out of that trend when the Fed goes, we can't print any more money. We just can't. We just can't. The end of the world will come. Aliens will invade, you know, a volcano will blow up. We just can't do that. And then it'll go crack. And then you know it's all over. So that's the only one to watch, is the S&P 500. And, you know, it should, I mean, the only thought that I've thought recently, which is going to make what hair Zach has stand on end, is that if you look at the Bank of England, they've done an $800 billion QE. Okay, so they bought £800 billion worth of government bonds off the market, which they've given them cash for, or whatever they've given them for. Well, the government has, of that, the COVID section of that is 300 billion. And the government has gone 400 billion in the red. Well, if the Bank of England just cancelled those government bonds, they've only actually spent an extra 100 billion. And if the Fed, which is the part of the government, it's not part of the government, it's a limited company owned by banks and all that crap. But if the Fed just went, oh yeah, government bond, you know what stock buyback's like, right? Oh, that's what we've done with the government bond. Well, that's $8 trillion worth of government debt that go vanish. So if you're, as a government, buying your own bonds back and giving people cash, you're not so far in the hole as you might think you are, because you're actually buying your own bonds back and putting them in the bottom drawer and saying, well, I owe myself 8 trillion, don't I? Well, you don't, do you? You can't, one left pocket can't owe right pocket 8 trillion. It's the same pocket, same pair of trousers anyway, right? So there is an element of people thinking that the Bank of England and the government's borrowed 400 billion over COVID, but actually they bought back 300 billion of their own debt, and they just tear it up. So it's not so far in the hole as you might think. So that's something that is working on in the back of my head. And now Zach's going to say, that's complete rubbish, aren't you?
No, it sounds great. It sounds no. I think that kind of sort of fundamental backup is always, it explains, or it helps at least, us get an understanding. But at the end of the day, I think we still have these problem with these phony controlled markets. These are controlled markets that we're in, and that's why it's much more difficult to make sense. Apart from just saying S&P is going up, gold's going to be is not going to go up, oil is going up, even though we're all going to be buying EVs. I mean, you've got all those everything. Nothing really ties up at all. Why is all $70 again? It doesn't make any sense.
Nothing ties up is where I'm at. Now, underneath all that, it's not that nothing ties up. It all ties up perfectly. I just haven't cracked the code yet. And that's what the job of the investor and the trader, for that matter, then the speculator is to tie because it's the aliens doing it. Or it's Biden. He's long gold and he's long oil and he's short gold, and it's all about his this or it's the IMF, or it's inflation, or it's China, or it's the Australian lockdown, or whatever. If you can find the right key, it unlocks all those situations. Then you go, I need to do this, I need to do that, and I need to do that, and you make a ton of money. And that is the game. Now, if you want to go away from trying to untangle the Gordian knot, you can go to things like dark trace, which is going to be worth 10 billion, because it just is, because that's the way companies like that work. And you can buy it, and when it's roughly 10 billion, you can sell it. You don't have to think about why the devil should it be worth that money. Why is Hargreaves Lansdown at an incredible valuation? Why does it Rightmove have a 60 PE and all those companies like that? Why did Fevertree, which makes tonic water, get a crazy valuation that it got when Britvic doesn't have it? You can forget all that, and you can take it from a different angle, which is what Zach is kind of suggesting you do, which is stick to a few obvious, simple things, and trade from a different point of view. I find that very difficult. I like to understand the whole big picture. I like to see the whole machine as the globe rotates. And right now, as Zach says, it's not tying up, which should really be really bad news. And maybe it is.
Yeah, well, in the crypto space, there is also lots of pressure coming from the SEC, coming from regulation. Now they want Coinbase, they're asking Coinbase to be regulated because most of their assets, they are actually security. So it kind of like, the crypto could go up, but there is also the element how you're going to tax people, right? You can tax them on real estate, but they want to tax them on crypto as well. So there are different components that they are kind of maybe holding on crypto, maybe.
I think Bitcoin would be $20,000 right now if it wasn't for this China situation. Because I think there's a lot of rich people in China burying their gains in crypto, and that's what's keeping it up. And I don't think they will, if China said, we're not going to be, we've done the clampdown now, it would go like that. But actually, it's quite likely that they're going to carry on going because they're on a little bit of a cultural revolution thing, and that could be the big theme coming. Because if China goes off the rails, boy, are we in for trouble.
Okay, so basically, watch China for crypto, and then pray for the market to make sense.
No, it makes sense. We just don't get it. And that's because it's very complicated right now because of COVID, because of QE, because of huge deficits, because of inflation, which is being suppressed, or at least the score is being suppressed. All the supply chain is broken. I mean, the list of chaos is as long as your arm, right? And I think that's what you're seeing in the market. And we all know if the Fed and the EU and Japan and whatever the UK's up to decided they weren't going to print more money, what would happen next? I mean, there's no doubt about that. So maybe the question is, are they ever going to stop? Well, that is the question. And my answer is no, they're not. And therefore, you know, money's going to be devalued. So you need to be out of money and in something that isn't controlled, like real estate. If you go to America and you buy a house, in some places they're charging 2.5% of the equity value of that house in tax every year. So, you know, I don't like real estate. Where do you go? The whole thing is pinned down, so it's difficult to know where you can go. Where is the escape hatch for this? That's what I'm looking for, the escape hatch. And I'm going to go when I find it.
Okay. So Clem,
I want to know Zach. Zach knows where the escape hatch is. Where's the escape hatch, Zach?
That was in Diamonds Are Forever. The guy he goes into a mini submarine off the oil rig and everything else. So that's what you need. Like as Blofeld, I think he had the escape hatch.
Well, I think, but where is the market? Where's the escape hatch in the market?
The escape hatch is, I suppose, I actually think the escape hatch is always small cap stocks, where you know all the say it's a company that makes gloves, you know all the markets, its management, it's this, it's that. So I think that's the thing. In a small company or a small sector, you can know all the, like Rumsfeld, you can know all the unknowns. And I think that's always an escape hatch. Anything else?
That is also risky, because small cap, yes, can be the escape hatch, but at the same time, because it's small, it can be the market that is manipulated. So it privileges some people. And
But you can't. You're gonna love this as well. ADVFN. I've known the company for 20 years. I know the business. I know what it does. I know the whole set, that mini space. And so for me, if I know the company and the investment that well, that is the escape hatch. It's knowledge, which is an escape hatch.
Well, let me tell you what the Bank of America say about that. They say in phase one stagflation, small caps is the big winner. Telcos is
There we are. There we are.
Zach, that was like the end of the conversation came up.
Right. And tech is number 3. Now, in stage 2 inflation, 1969 to 73, you might consider that runaway inflation, is commodities, farmers, and copper, which I suppose you could take that as being gold as well. And the losers, small caps. They're the biggest losers in runaway inflation, small caps. And in the final leg, phase 3 is the same period. What a joke. Anyway, the final leg of stagflation, small caps is the winner again, as is value, and as is REITs, and the loser is tech. So small caps for the beginning of this, which is where we are now, and the end of this, where we aren't yet. Yeah, and apparently commodities do badly in stage 1 of stagflation, according to the Bank of America. They've done the research. So Bank of America.
I'm not a great fan of Bank of America, but anyway, but at least, but no, I think that was the point, that is just to know everything about a small area rather than trying to know everything about a big area. I think that's really the angle I'm going for. So, I've got to head off into the sunset now, as it's high noon.
Listen, next time, Zach, bring some shields on company that we small cap that we want to analyze, so we can see what Clem thinks about it and what I think, and maybe we can bring up.
No, I think but I mean the ADVFN example was an example, because it's my area, it's the area I work in, I'm familiar with it, and that for me is always a defensive. That becomes you know that area like the back of your hat. So
What is small cap? What's the limit on small cap in this day and age? What's your top market cap to keep under which?
Probably 100, actually. Yeah. Probably 100.
I think that's right. I mean, institutions say it's 300, but
some they say 50.
It should be in the institution.
No, 50 million, which is a bit small, but I think probably 100 is a fair one.
No, that's micro cap.
Yeah. Well, it depends on which broker you talk to. Let's say that way.
Cool. Okay, well, see you, Zach, and I guess see you, Steffi.
Cheers.
Thanks for having me
Yeah, I
again.
will see you all next time, and thank you